Okay guys, so welcome back to lesson number 2. Now we're getting a little bit more practical, and in this lesson we are going to discuss how to read the footprint candles. So as I said, on first glance it might look very difficult, but it's actually very easy. Now before we get started, really quickly, a lot of you have been messaging me also from the last video in regards to where to get the software. The software is included with the Orderflow program. Okay, I'm not selling them separately, it's literally both together. So the software and the Orderflow program are both like literally being sold together. Okay, so whether you want the one or you want the other, it's all in one package. So head down into the description, that's where you can get access to the software down below. Okay, now once that's aside, how to read the candles. I'm going to simplify it very quick. This should be a fairly short video anyways, because there's not much to go about this. Okay, so how to read the candles. Now the candles are actually read diagonally. The numbers are read diagonally. So as you can see here, from 6 to 9, 180 to 6, 9 to 84. Now on the left side, the numbers represent the lots sold into the bid, and on the right side, this represents lots bought into the offer. So this is the bid side. You'll hear this a lot: bid and offer. So this is the bid and this is the offer. Now when the market was 1.1558 bid, 1.1559 offered, 2 lots were sold into the bid and 65 were bought from the offer. So as you can see right here, in the market at this price level, 2 lots were sold into the bid and 65 were bought from the offer. Once again, at 11560, 67 was sold into the bid, 430 was bought from the offer. The market now did not go to 1.558 offer because the offer volume was simply 0. The volume would be greater than 0 if the market was offered at 1.558 and trade at that price. Okay, so I mean that's pretty self-explanatory. Now the buyers and sellers are always competing with one another. Buyers prefer higher prices. Okay, we understand that the buyers want to continue to keep pushing prices up, while the sellers want to continue to keep pushing prices down. Now you should always, in the market, you should always, while looking at a candle, try to ask yourself who is in charge. And the market is always telling you who's in charge, especially when you have the capability to be able to read a naked chart like this, when you're able to look at the candle, uncover it, and be able to tell. Now a lot of the time, looking at the candle itself is not going to tell you too much. Sometimes the candle is literally not telling you too much because there's so much data that you don't understand what is going on. So this is why sometimes we like to group candles as well. Look at candles in accumulation, look at candles in sets of like 4 or 5, look at the whole range. Okay, look at the whole trend and what the candles are saying there. Now, being able to just look at the numbers here on itself, like a lot of time when we're looking at the footprint chart, we're doing our order flow analysis, we're not looking at that. I'm showing you these things right here because this is simply fundamental. Okay, this is the fundamental thing, this is the foundation of the concept. And like being able to tell who's in control from the buyers or sellers right here, where we don't actually do that just by looking at the 56. You don't look at the bid and offer. I mean, you can do that, but there's much more simpler ways to actually determine who's in strength. But it's very important that you're able to uncover this. Now moving on, there's 2 types of traders in the market. A lot of the time, okay, people say that there are more buyers than sellers, or there are more sellers than buyers, and this is what moves the markets, and that's simply untrue. Okay, both buyers and sellers fall into 2 different categories of traders. We have 2 different categories: passive traders and aggressive traders. Now starting off, the aggressive traders. The aggressive traders are simply traders that enter the market at the current bid or offer and is unwilling to wait for price to come to them. So aggressive trader is simply me going onto my MT4 right now and simply just market executing whatever the current price. I'm taking the current price. Okay, whereas the passive trader is somebody who waits for price to reach their desired level, such as more discounted or premium levels, before attempting to interact with the market through pending contracts. Of course, so these are the people that are waiting, okay, with their buy limit, with their sell limit, because they believe that the price is going to reach better prices in their opinion. Okay, so they are the buyers most of the time at the lows and at the highs. So they are the people, okay, these are the traders that a lot of time they set the low because a huge surge of them come in because they determine, okay, this is a cheap enough price or this is an expensive enough price, and they're able to, you know, form that reversal or form that pullback. Now So before we go any deeper into this lesson, make sure you check out the free Orderflow ebook that I've prepared for you down in the description down below. And with this ebook, it's an introductory ebook that you can use and read alongside these lessons that you're currently watching at the moment. And at the end of that ebook, I show you one of the confirmational setups that I like to use when it comes to smart money and Orderflow. So make sure you download that ebook in the description right now, and let's continue with this lesson. Taking a look at a little bit more deeper into aggressive traders. Aggressive traders, as I said, who buy into the offer. Aggressive buyers are traders who buy into the offer, and aggressive sellers are traders who sell into the bid. So the aggressive buyer are the traders buying into the offer, so they're buying straight right here. They're buying right at the price level right here, and the aggressive seller is buying straight into the bid. Now, when we talk about aggressive buyers, what we really mean is that there were more trades executed on the offer side than the bid side. More people were buying from the offer than selling into the bid. This is what aggressive buyers and aggressive sellers actually mean. Now, to quickly explain, the market is actually, like the way prices function, the way transactions are occurring in the market is done through a concept called two-way auction. Okay, so essentially what this means here, let's take a look at the two-way auction. There's essentially going to be two prices, okay, the bid and the ask. Okay, we have the bid and the offer. And in order for price to either move lower or in order for price to go higher, okay, in order for it to go from here to here, from here to here, you need one entity to match the other. So you need, and think of it this way, to simplify it, I'm going to give you an example. Let's say that I'm looking to buy a car, I'm looking to buy a house, I'm just looking to buy something. The seller is going to set his price, and that's the market. This is the market price. And then the buyer can also put in an offer. The buyer can say, okay, the seller's amount is 50k, but I'm going to wait for price to come to 40k. This is my offer. So one has to match the other. The seller either has to come down to the buyer's price, or the buyer has to go up to the seller's price. Okay, so right here, in order for price to move up to the next price level, in order for price to move to the next price level, one has to come down. Either the sellers have to come down here and hit the bid, or we need the buyers to come up here and hit the offer. And in order for price to move to the next level, depending on the contract size, the buyers, okay, they have to hit the offer with contract sizes over 145. So all of this has to be swooped up 145 in order to move to the next one. So understand that in every single candle, there's going to be passive buyers, passive sellers, aggressive buyers and aggressive sellers. And there has to be, okay, for every transaction to take place, one has to be passive and one has to be aggressive. Okay, one entity has to be passive, one entity has to be aggressive. It's very, very important that you are able to understand this. So moving on then, we have the passive traders, the passive buyers, traders who buy the bid, and then the passive sellers are the sellers who wait for the price to come to them and they sell the offer. So a lot of time, in order for me to buy, okay, the passive sellers, they wait for price to come down to them and then they'll buy the bid. They wait for a price to come down to them, then they'll buy the bid. And then the passive seller, the trader who sells the offer, they're the traders that wait for price to come up to them. Okay, so they sell the offer. They wait for price to come up to them for 67, 8, 180. They sell the offer. Okay, and once again, the two-way auction literally occurs in the same way. Having a strong understanding of this concept is very, very important because it shows you that just because candles look very, very bullish, and the candle pip range is increasing and you're seeing a lot of aggressive buying into the candle, doesn't mean that this range will last, because you don't know when passive sellers are going to come into the market. And these passive sellers, a lot of time what you see is when it comes to a reversal, it's so strong up, but then it's like meeting a wall. Okay, it's like just crashing into something, and then the price just drops intensely as well. Okay, and nearly even more strength than the buying was occurring. And a lot of the time this is because look, price is aggressively buying up, constantly hitting the buy, the buyer is constantly hitting the offer, and then eventually, okay, we reach the zone where a lot of passive sellers step in. Okay, a lot of passive orders now get triggered and the market just completely melts. And this is very, very important because you need to be able to understand that there's these two types of traders in the market. Now, understanding how the market moves and, determining the direction of the market through kind of the way that I just showed you there, and that theory is actually pretty difficult. Okay, it's very, very difficult. There's more practical ways of looking at the market, but it's very, very important that we're able to cover, first of all, the theory and the true way that the market actually moves. Okay, so very, very important to understand the concept. Now, that is pretty much it for this lesson. I mean, it's a lesson where we're discussing more of the theory and how the market moves, and in the upcoming lessons and in the next lesson, I'll show you a little bit more on how to actually be able to analyze the market from a more practical way, because simply going through every single executed contract and trying to understand where the aggressive sellers are stepping in, where the passive buyers are stepping in, etc., can be done for sure, but it's very, very time consuming, and by the time you figure all of that out, the trade would have been done. So there's more practical ways of doing this, but